If the U.S. economy were a roller coaster, it would be a wild ride full of twists, turns, and occasional moments of terror. The U.S. economy is constantly in flux, with the stock market soaring one day and crashing the next, leaving investors and analysts scratching their heads. It's a bit like playing a game of economic whack-a-mole. Just when you think you've got it under control, something unexpected pops up to throw a wrench in the works. So hold on tight, folks, as we talk about what's really happening in the U.S. economy today, and where do we stand in this constantly changing economy. Bloomberg Surveillance recently invited analysts and experts to talk about what's really happening in the U.S. economy today. Bloomberg Surveillance is a TV program and podcast hosted by Bloomberg News. The show focuses on providing insights into the world of finance, economics, and politics, with a particular emphasis on the global markets. This program features interviews with prominent figures from the financial and business world, including CEOs, investors, economists, and policymakers. So much about Bloomberg, but anyways, during their March 22 airing, experts have talked about how the economy has undergone a full round trip these days.
Equity futures right now on the S&P down about 0.1% on the S&P 500. Lisa, this S&P 500 back to where it was before the banking mess. We've done a full round trip.
Everything's been a full round trip.
The term full round trip refers to a situation where an asset or market index returns to its original value after experiencing a significant fluctuation. Think of it like a yo-yo. You throw it down, it goes up and down a bunch of times, and eventually, it comes right back to your hand. Simple, right? In the video snippet that I showed you, experts have discussed that one of the things that have gone on a full round trip is the S&P 500. It's been a wild ride for the S&P 500, folks. Just like a boomerang, it's flown out of our hands, taken a few twists and turns, and then comes right back to smack us in the face. Back in early 2020, the S&P 500 hit an all-time high, and everyone was feeling pretty good about themselves. But then, like a college student after a night of heavy drinking, it stumbled and fell hard, dropping by a whopping 35% during the pandemic-induced market crash. Cue the dramatic music, because it's time for the comeback story. Since then, the S&P 500 has rallied like a superhero on a mission, clawing its way back up to pre-pandemic levels, and then some. In fact, it's hit so many new highs recently, just like in October 2021, where the S&P 500 hit a new record high of 4,556.77, driven in part by strong corporate earnings and optimism around the economic recovery from the COVID-19 pandemic. This marked the index's 66th new high of the year, surpassing the previous record of 62 new highs set in 1995. The S&P 500's impressive run of new highs in 2021 has left investors feeling bullish about the stock market's prospects, despite ongoing concerns around inflation, supply chain disruptions, and other challenges facing the global economy. Of course, as with any investment, there are always risks to consider. But for now, the S&P 500's string of new highs is a testament to the resilience of the market and the potential for investors to achieve long-term growth. Now, going back to what I said about the ongoing concerns. Since time immemorial, inflation has been a problem to the economy.
Which is inflation. And basically saying we have all the tools we need to fight any kind of financial instability, so we're going to be focused on inflation. Inflation keeps surprising to the upside. And this is where really, I mean, you look at UK this morning coming out with another hot print. This is the conundrum, and it's not that different for Jay Powell.
So what is inflation, you ask? In economics, inflation is when the general level of prices for goods and services goes up over time. This means that the purchasing power of your money goes down, and you have to spend more just to maintain your standard of living. It can be caused by a variety of factors, including supply chain disruptions, government policies, and changes in demand. The problem with inflation is that it can spiral out of control if left unchecked. If prices keep going up and up, eventually people stop buying things, and the economy grinds to a halt. Plus, it can erode people's savings and make it harder to plan for the future. As companies raise their prices, consumers might start to cut back on their spending, since their money doesn't go as far as it used to. This can lead to a slowdown in the economy and a decrease in corporate profits. Now, looking at how this could affect the S&P 500, for example, the index is made up of 500 of the largest publicly traded companies in the United States. So if inflation causes a slowdown in the economy, many of these companies could see their stock prices decline. This is because investors may become less optimistic about their future earnings prospects. This is why, as discussed in Bloomberg Surveillance, even if we are facing decent trading, which is a good thing, and say that we are now reaching a point of stability, in actuality, we are not.
Seems to have garnered a bit more stability in some of the regional bank stocks. Today, we're seeing an ongoing rally in First Republic Bank. Those shares up 3.4%. Although we're talking about this rally, and when you actually take a look at the stocks, they're so far off the highs that we still have a long way to claw back the same kind of feeling of stability that we had earlier.
While many people may be saying that we are reaching a point of stability, the truth is that the global economy is constantly evolving and changing. There are a number of factors that can disrupt the status quo, from geopolitical tensions and natural disasters to technological disruptions and changes in consumer behavior. One of the main reasons why we are not reaching a point of stability is because the world is becoming increasingly interconnected. Economic and financial developments in one part of the world can quickly have ripple effects throughout the global economy. For example, a trade dispute between the United States and China can impact supply chains and trade flows around the world, while a natural disaster in one country can disrupt production and distribution of goods and services worldwide. Another reason is because the future is always uncertain. While we can make educated guesses about what might happen based on past trends and current data, we can never be certain about what the future holds. This uncertainty can make it difficult for individuals, businesses, and governments to make decisions and plan for the future. So with all that has been discussed, there's only one thing that I can tell you, guys. Expect the unexpected. Who could have predicted the great impact of a global pandemic on the economy? But despite the unpredictability of things, there are steps we can take to prepare for the unexpected. Building emergency funds is a critical part of this preparation. In times of crisis, having a financial cushion can make all the difference. Emergency funds provide a safety net for unexpected expenses, allowing individuals and businesses to weather the storm. Staying informed is also essential. As different crises have shown us, things can change rapidly. Staying up to date on the latest news and developments can help us make informed decisions and prepare for what's coming next. It's like having a weather app on your phone, which I too have one. You can't control the weather, but you can prepare for it. Lastly, maintaining a flexible mindset is another key factor in preparing for the unexpected. Being able to adapt and pivot is crucial in times of economic crisis. As the saying goes, the best laid plans of mice and men often go awry. But having a flexible mindset can help us adjust our plans and move forward in the face of uncertainty. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Soon channel. I'll see you in the next video.